The second. All righty. Well, welcome everyone and happy Wednesday. My name is Colin Evans and I'm part of the business development team here at Baird. And on behalf of your Baird advisors, I want to thank you for joining us for today's Baird Wealth Strategies webinar, All That Matters. With 2026 underway, it's a good time to assess how your investment strategy is positioned for the year ahead. And we're pleased to welcome Baird market strategist Mike Antonelli and investment strategist Ross Mayfield to share insights on market trends, policy developments, and their outlook for investors. But before I turn the call over to Mike, I have a few housekeeping items that I'd like to highlight. All participants are currently in listen-only mode, but we'd love to hear from you. And we will host a Q&A session at the end of the call to address as many questions as time permits. You can submit a question by clicking the Q&A icon. Please be sure to address your questions to all panelists. This presentation is being recorded and will be available along with the slide deck through your Baird financial advisor about a week following today's call. And with that, I will go ahead and turn it over to Mike.
Thank you. Thank you so much, Colin. I really appreciate it. Thank you, everybody, for joining. There's about 200 people live with us today. Many more have registered. So if you're watching this live, thank you so much for joining us. We're going to spend about 30 minutes talking about what's on our minds as we start the year. There's a lot kind of going on that we need to kind of lay the groundwork for as we think about what's going to happen this year. And then if you're watching on a recorded link, thank you so much for taking some time out of your day to watch this from your home or wherever you're watching from. I'd like to introduce my friend Ross Mayfield over there, or wherever he is on the map. Ross, excited for this?
Yeah, I'm pumped. I'm here in Louisville. Where are you at, Mike?
So I'm in Milwaukee. We're prepping for the misery that's coming this week. I'm sure most people in the country are. I wanted to just reiterate that you can ask questions during the webinar. There's a little Q&A function. You'll see it. I'll put a little chat in there myself. You can put questions in there along the way. You can do some near the end if you'd like. But we're happy to answer questions along the way if there are any. We will also do a couple questions that we've prepped ahead of time for everybody. But if you do have questions along the way, please do put them in the Q&A section. So we are calling today's event Your Investing, Never-Ending Investing Journey, because Ross and I do these every year. We do these live. We do these recorded on webinars. We do these one-on-one with clients. We do them all over the place. And what we have noticed is that what we do as a career, what we do to help people through difficult times is never ending, right? Ups, downs, news, no news, all sorts of things. So we are going to talk about your never-ending investing journey today. And we're going to kick it off with a slide that my friend Ross created that he's going to talk you through a little bit about what we're going through right now. And is it good or is it bad? Or how long is it happening? Ross, explain to our listeners, our clients, our most trusted contacts, what's going on in the world in terms of the bull market right now?
Yeah, so thanks, Mike. Thanks, Colin. Thanks, everybody, for being here. At the highest of high levels, obviously a lot has happened to start the year, but the number one question that Mike and I get when things are going well is, can this possibly last? How long can this last? Is it, some version of, is it a bubble? What should I be doing at all-time highs? When markets are going down, we know usually the reason that that's happening. When markets are going up, we still have this human anxiety, but it gets placed on the length and strength of the bull market and whether it can continue. So we wanted to start at the highest of high levels of this bull market we're in now. How does it stack up to other bull markets of most of our investing careers, right? The last 50 years. And so the red line is the current bull market. This is every bull market for the broad US stock market that has made it to a second birthday. So bull markets with some staying power. And we wanted to say, what do those look like through history? What can we maybe expect if we're using history as a guide? And for bull markets over the last 50 years that have made it to a second birthday, as the current one has, the shortest are 5 years. The longest you can measure in double-digit years. The weakest go up 100 to 200%. The strongest go up north of 400, 500%. So if this bull market were to end today, it would be one of the shortest and weakest in this category of the last 50 years. So There are reasons that we think it'll continue. We want to get into that whole analysis, but I think that to start things off, bull markets tend to go longer and stronger than we expect they could or should, and that's been the case throughout history. If this one weren't to be like that, it would be a major departure. So does that square with how you're thinking about things to start the year, Mike?
Yeah, I just want to put some numbers into this so you as a listener can kind of think about what you've been through. So remember 2022, how horrible that year was? Inflation was bad. The stock market had a bad. The bond market was bad. Like 2022 was just a tough year. I remember it very distinctly in my travels. That was when the market bottomed. Okay, so from then to today, which is this chart Ross is showing, saying it's about 3 years so far, the stock market's up 100%. 100. A basic 60-40, which is what a lot of wealth management clients do, right? 60% stocks, 40% bonds. That's what most wealth management clients like to have for a portfolio. That's up about 60%. It's incredible numbers. Incredible. From the last 3 years have been an incredible time for you to grow your wealth and expand your purpose and values. Only if, though, you manage to stay the course, which we're going to talk about a little bit later. You only get to reap these benefits of feeling more secure about your financial future when you are invested, and you have to invest through difficult times. So I just want to put things in perspective. It has been really, really good to be an investor for basically almost 15 years now. You are living through a golden era to be an investor. So I hope that you view it as such, because the stock market and investing has just done an incredible job to grow and compound our wealth. Ross was talking about bubbles. We get asked about AI bubbles a lot. He had this great chart that he put together showing the late 90s. The late 90s is often brought up as like, are we like the late 90s? Remember, the late 90s was a bubble. Is right now as scary as then? Ross, just kind of talk them through. Is it as scary as then? What kind of magnitude are we talking about here?
Yeah, absolutely. I mean, this is the number one question we get asked right now. And I get it, right? It's a new technology, just like the internet and the personal computer was a new technology in the late 90s. We're in a robust bull market, as you just laid out, right? Strong stock bond returns, strong metal returns, strong commodities returns. Like, this has been a great bull market. It's got a technology at the center of it, an unproven and new technology that is causing a lot of anxiety. And so there's an obvious comparison to be made, especially since a lot of investors lived through that time. So it's easy to call to memory. The one thing that I think is really important is that we put a definition on a bubble, right? It has to be a price that goes basically parabolic, right? Completely detached from any sense of fundamentals or even an optimistic view of things. And that's what this is, right? So we index the NASDAQ, which is tech stocks, the ChatGPT's release in November of 2022, and the Netscape IPO in August of 1995. Just to say, these are when these two markets really got going. This is when the new technology really announced itself. How's the market hold up? And I think it's stark to say, we've had this robust bull market, and it does not hold a candle to the late 90s, Mike. It does not hold a candle to what we saw in the late 90s, and particularly in the last couple of years of that bull market, when it really did morph into a bubble that was completely detached from the fundamentals, and when every bear on Wall Street basically had to throw in the towel. We're nowhere close to that.
Yeah, this is a great stat Ross has. The NASDAQ quadrupled in 17 months, quadrupled in the late 90s. We are nowhere near anything like that at all. So what I did, I'm a history guy. When I go on the road, I like to tell stories about history. The next slide is going to tell you a little bit about the past. So the United States of America has gone through many different investing cycles, okay, where a dominant theme occurs and we start to pump a bunch of money into it. We call them national investments, okay? There are quite a few through history, but I picked out 4 others that we went through in the past, and how long it took for those to peak, okay? So post-World War II, the U.S. auto industry took off. And as a nation, we spent about 5 years investing in that before it peaked and started to slow. Railroads, okay? In the 1850s, railroads, about 4 years and 9 months, the nation spent investing in that theme. Telecommunications in the mid-90s, about 5 years and 6 months. Oil and gas in the 80s, about 3 years and 9 months. What we're going through now, the AI, is a national investment. We are pumping a huge amount of our nation's wealth and GDP into AI. and it's lasted about 3 years, a little over 3 years. So compared to other massive investments in our nation's past, it's still pretty young, okay? It's still 5 years for autos, close to 5 years for railroads, 5 years for telecom. I think what the point Ross and I are trying to make is that these things can go on longer and you can benefit from them as long as you don't get scared out by bubble talk and charlatans online are trying to make you afraid of everything that exists in the world, okay? I am here to tell you, and Ross would agree, AI is moving at a pace that you cannot believe. I have seen things, even in the past month, that blow my mind with AI in terms of productivity and developing websites and shop. There's so many things happening, and they are not replacing people's jobs. We're not firing people as these things come online. We are just figuring out at Baird, we're trying to figure out what's the best way that we can use these productivity gains to help our clients. That's every company is thinking of that right now. So let's move on really quickly to last year. I'm going to toss it over to you, Ross. Last year, the stock market did about 18%. Was it fake? Was that 18% fake?
No. One great year, 18%. In any year, you'd take that 100 times out of 100. Coming on the heels of 25% plus the 2 years prior to that. The important thing about 2025 and why we have this slide, as we look ahead to 2026, it's important to dissect what drove those gains in 2025. And I think it gets to like a really core truth that is obscured a lot by the way the news covers the stock market and the way the news covers domestic politics and geopolitics, which is our portfolios, are typically made up of stocks, which are part ownership shares in real companies whose prices go up over time if those companies are growing their earnings. They don't always match one for one. At the beginning of bull markets, stocks go up more than earnings. At the end, sometimes earnings go up more than stocks. In 2025, we had a perfect marriage of stocks went up, and it was driven almost entirely by sales growth, profit margins, and dividends. The earnings and cash of the companies you invested in drove the gains in the market. So any gains in the stock market are real, in my opinion. You can click sell, and that money is in your account. Yeah. In this case, though, we are really, really lucky to have the baton handed to earnings and profit growth to drive this bull market. And it's the reason that if we look at the chart a couple slides ago about bull markets that make it to their second birthday, this is typically what you want to see in a bull market that has real legs, is earnings, profits, fundamentals, cash flow, the actual businesses that underlie the stocks we talk about all day are doing really, really well. And can they drive that another year? I think they can, and we'll talk about reasons why. But this is really important to internalize. It is real cash going into these companies' coffers.
Yeah, Ross has got another chart basically telling the same story. The light blue line you're seeing on your screen is the market. It was up 96% since December 2020. The blue line you're seeing here is earnings expectations, okay? Earnings expectations. So the market is actually following earnings. But you might not be putting that together in your mind because you're probably just not thinking about it because you see the news or you see headlines and you say, why is the stock market doing what it's doing? There's Greenland, there's Venezuela, there's Ukraine. You're saying, well, I don't understand. When the answer, the simple answer, and we like to give simple answers to our clients, is that the companies of the United States are earning more money. That's the answer to why the stock market has gone up so much. Companies are earning more money. Okay, that's as simple as we can make it. Is there a way to time this? Could we once we say Mike and Ross, when earnings start to fall, can we get out of the market? The problem with that thesis is that the price tends to fall before the earnings do. Okay, price tends to lead the earnings. So we can't say, oh, earnings are about to fall, therefore we should not be in the stock market. That's just not how it works. What tends to happen is something happens in the world that actually does affect the stock market, like a recession, and then the stock market falls before earnings estimates start to come down. But I think we want to just wrap up this section before we move on to talk about the Mag 7, which is always on people's minds, that the stock market is going up because of earnings, the profits that the companies of the United States have, okay? That's really important for you to digest. So the Mag 7, these big 7 tech stocks, we've always been told, the media tells us, blogs tell us that it's just these 7 names. Everything else is doing terrible. Ross, is that true?
No, not at all. So in 2025, again, a kind of an inflection point, right? Where we talk about earnings driving the market higher. And the other thing we want to talk about is the other 493 stocks, the non-Mag 7 stocks, the non-big tech concentrated stocks did a lot of work, a lot of financials and industrials and real economy companies, small ones that don't get covered because they're not big in the index, but are again growing their earnings and their profits, and they contributed a lot to the overall S&P 500's growth. Again, if we did about 18% last year, over 10% of that was the other 493. Now, the good news is it's not mutually exclusive. The Magnificent Seven rose, they made money too. So it doesn't have to be one or the other. And then zooming even further out, last year, global stocks, non-US stocks, had their best year relative to the US since like 2009. So if it were just AI and if it were just the Magnificent Seven, we wouldn't see either one of these things because the Magnificent Seven are all in the US. Global, like international countries, they don't have a big tech sector like we do. So if international stocks are outperforming, it almost has to be other sectors and types of companies doing well. And what that says to me is this bull market is a little more robust than it's given credit for. It's driven by a lot more than just one trend, although AI is important and we talk about it a lot. And we are, I think, both believers in it as a big productivity enhancer. It's clearly not just that. And so, at the end of the day, again, it doesn't matter. Returns are returns, but it makes it a lot more robust because what we're seeing right now, Mike, and you've been all over this, is the AI stocks are not working so well. And the stock market has still done pretty good.
Yeah. To start the year, the Mag 7 last year didn't really do like gangbusters. And this year so far, industrials and energy are actually doing really well. The tech stocks aren't doing really well. And again, that's what we call rotation. That's just a fancy term for people are moving from that to that. And the notion that it's just 7 names it's just not true. It's an absolute myth. It's not just 7 names. Those names are important to the stock market, yes. But last year, the other 493 stocks contributed more to the market than the 7 did. That's a really, really important thing for you to remember. There's lots of myths that people are going to throw at you to make you worried. All that matters, which is the series that Ross and I do, we do it on YouTube every month. I hope you're watching it. All that matters exists to break those myths, to stop you from making a mistake based on something that's just not true or something that somebody's trying to scare you with. Let's move on. We got to move quickly because there's going to pile up some questions here. There is some stimulus still in the pipeline for the United States of America. You're like, what is the stimulus? Are they going to send us tariff checks? Like, what actually is the stimulus that's going to happen? Well, remember the one big beautiful bill, OBBB tax bill passed last year? There was a lot of interesting components to that, like no tax on tips. So what's being projected right now? What's being projected is that federal tax refunds, which come in April and May of this year, are expected to be at some of the highest levels since 2009. So the average tax refund in the United States, it's like $3,000. We're looking at closer to 5,000 now for the United States. Just an incredible, incredible number. And here's what I want you to remember. Actually, I'm going to ask my friend Ross, see if he knows the answer. Okay, Ross. When Americans get a tax refund in April and May, say it's $3,000, $4,000, $5,000, what do they tend to do with it?
They probably squirrel it away, pay it down. No, they spend it. Of course they spend it. The U.S. is a consumer economy. We are nothing if not consumers. Whatever you think about that, it is the truth. Our economy is about 70% consumption. This is really going to help the lower income cohort in particular, who has been struggling with rent increases and inflation. This is a massive tailwind of consumer stimulus hitting the United States at the same time that the Fed is expected to cut rates, at the same time that the federal government is slashing some regulations to make companies do business a little bit easier. There are a lot of cross currents in the world right now, but at home in the US, where most of our businesses do all of their business, this stimulus is just going to be a huge tailwind. So I don't think it can be overstated, especially the consumer tax refund piece. And if you're wondering how this is possible, they did a lot of tax cuts, but we didn't adjust withholding tables. So people are just going to get a lot more back. And it's, what do? We spend it, Mike. We're nothing if not great spenders.
Yeah. Remember, one of the key components to the stock market's returns, remember, is that earnings of the companies in the index matter. And earnings of the companies are driven by, most likely, consumers, right? Consumers. So we do have a question. I'll just really quickly regarding tax refunds. Will that be concentrated in high income earners or help all tax brackets? Remember, a lot of the things in the one big beautiful bill were for non-high income tax earners. So as an example I just gave, no tax on tips, which is for bartenders and waiters, that will directly affect people who are not high income tax earners. That is, bartenders, waiters, servers, those things that rely on tips, that will go into their pockets. That will help that entire cohort. There are lots of things in there that weren't just directed at high income earners. So we are super excited about the fact that not only rate cuts might help with mortgages and stuff like that, but you get a higher nominal value on tax refunds, and that should be a positive for the stock market in the spring. But all right, we got to talk about midterm election years. It's a midterm election year. I feel like we're always talking about elections. That's just a very, very frankly brutal part of our jobs. But it's a midterm election year. We got to talk about those really quickly. We want to prep you on something. The next slide is going to prep you on something. But first, if you were to break up the 4 years of a presidential cycle, year 2 is typically the lowest of the returns. Why? What happens in year 2? I mean, why would they be, Ross, the lowest of the 4?
Yeah, I mean, part of it could just be bad luck, right? 2022, high inflation, like that didn't have a lot to do with midterm. But in midterm election years, presidents and incumbents really want to get reelected and keep their seats in the House. They tend to push on more policy levers. There tends to be more uncertainty because the market is trying to anticipate what the mix is going to look like after midterms. And you're typically coming off of a nice year 1. So there tends to just be more uncertainty that results in bigger drawdowns. We'll talk about that. I'll give it back to you.
Yeah.
And just generally more volatility, the lowest returns of any year in the presidential cycle. But again, like if the average is 8%, you'd still take that most days of the week. Like that's still a nice return. You still have years mixed in like 1998, in the middle of the dot-com boom, 2014, a great year coming out of the great financial crisis. And then before I turn it over to you to prep everybody for what to expect this year, I would say after what Mike says, remember the table on the right, which is that there has not been a year since 1938 in which the stock market was down 1 year after midterm election. So every midterm election since 1938, the stock market has been higher a year after the polls closed. So a lot of volatility, maybe lower returns in the year, but a great buying opportunity once the market kind of lets things settle out and we get to move back to the things that actually matter, like earnings and federal policy making, the things that we've already talked about. So Mike, what should we expect this year?
Okay, so I have a forecast for you. I'm going to put my weather cap on, but move it to the markets. There's a big storm coming this weekend. We all know because the weathermen are telling us nonstop. It's going to be cold. There might be 20 inches of snow in Nashville. It's winter in the United States. Storms happen. We expect them. There will likely be this year, this calendar year, a quote unquote storm, a quote unquote sell-off. Why? Because the average midterm year sees a 17% sell-off in the market. Okay, so you take every midterm year all the way back. It experiences on average, doesn't mean this number is going to happen, on average, a 17% sell-off sometime during the year. Now you might say, Mike, okay, you gave me a forecast of 17%. I'm just going to get out right now and get back in, right? I'm going to wait for the 17% and then I'm just going to get back in. Again, we don't know whether it's 17, could be 2, could be 3, right? We don't know what the actual number is going to be. Why does this happen? Well, Ross mentioned it. Typically, when a president is in his midterm year, he spent a lot of his political capital already in his first year, right? To get one big, beautiful bill, all those things done. Typically, when you're in the midterm year, the electorate of the United States likes to change parties. We love switching parties in our government. So the market starts to say, oh, I don't know what the makeup's going to be. I don't know what's going to happen. So I'm going to be a little volatile. That's what tends to happen in midterm years. This is not something we can time. Remember what Ross just said. After the polls close, a year later, the stock market's been positive every year since 1938. And we know past performance, no guarantee of future results. We have to say that. What I'm doing is I'm prepping you, just like the weathermen prep us for storms. Markets tend to have volatile midterm years. It tends to happen. I want you to remember, though, the 17% number. I want you to remember that the stock market has a 10% sell-off virtually every year. So 10 happens pretty much every year. And you probably don't remember any of them. All the way back, I bet you don't remember any of them because we're basically at all-time highs right now. So I just want you to know, be thinking about this, that midterm years are volatile, and they tend to get volatile in the summer. That tends to be when the volatility is at the highest because the election is approaching. So just remember that. We're going to talk you through it when it happens. Your advisor, us, Baird, will get you through these moments. Just know that midterm years can be a little dicey. So this is a bit of a noisy slide, but we get a lot of questions about Venezuela, Greenland, Ukraine, Israel, Gaza. We get a lot of questions about this stuff. Ross, what's the simplest way to tell clients what matters?
Yeah, so the chart is basically like it's an incomplete list of kind of big geopolitical events, particularly ones involving the U.S. Since 1940, and how the market is done. There's not a lot of signal there, except to say that most of the time, 6 to 12 months later, the market is higher, even for events in the moment that felt pretty volatile. We're happy to provide this, if anybody wants a larger version of it. But you wrote a blog in response to the Venezuela stuff to start the year, right? Yeah. What moves the U.S. stock market? Because the market opened the morning after that event over the weekend and shrugged. It went higher, and there was some anxiety, like, hey, why? I don't understand. Why is the market looking through this? Is it missing something? And so, what moves the stock market in the end? And this is kind of what we've been talking about. Number one, earnings. Number two, rates, and then number 3 and 4, flows in and out of the market and sentiment. How are investors feeling, right? The questions you should be asking whenever there's a geopolitical event in the news: will it impact U.S. earnings? Will it impact the U.S. consumer? And those are somewhat intertwined. But when you look at Venezuela, which is a very small portion of global GDP, a lot of U.S. companies don't do business there at all. A super small percentage of overall revenue comes from there. And it's far away from the U.S. Like, the U.S. consumer is not impacted in the way that they were in, say, 9/11, or in the way they were in, say, the 1970s when the price of gas went way up because of the oil embargoes. These are the questions to ask. And we have a question in the chat about tariffs, and those matter, right? Those hit the bottom line of U.S. companies, of consumer borrowing. That's why Liberation Day in April was such a big sell-off. And I think that's why, yesterday we saw a bit more volatility in relation to some of the Greenland negotiation, because there's a little bit more on the line in terms of earnings and interest rates. And so, Mike, I'll ask you if you have anything to add on that, but those are the questions to ask. Not every geopolitical event that is important in real terms to the world, to the people of the country or the region, necessarily has to be important to the stock market, especially the U.S. market.
If you have a question, if you're sitting at your home and you see something on the news, okay, or in a blog, or your friend at the club talked to you about it, Greenland, Venezuela, Israel, Gaza, anything. I wrote this blog specifically for you. It's sitting on Baird Wealth. What moves the U.S. stock market? Go read it. Anytime you're thinking in your head, will this matter? This blog should help guide you through that moment. What moves the U.S. stock market? Greenland or Venezuela doesn't affect the things that I have listed here, okay? Remember, there are complex things that happen in the world. Ross and I are not here to weigh in on the politics of history. We do not exist to weigh in on whether this is good or bad for the United States of America. We are here with your advisors and all of Baird to help manage your financial life through incredibly uncertain moments like this, okay? What was the most important lesson from 2025? There was a question in the chat. Have we seen tariffs impact the market in the past few months? What does that say about the future? There was a study recently done about the impact of tariffs. I believe it was JP Morgan, it might have been Goldman Sachs. And they noted that the bulk of the tariffs were paid by US consumers and some by the importers, very little by the other nations and the companies. US consumers are basically shouldering the impact of tariffs, because when an item comes to our shores, the importer pays the tax, the tariff, and then he or she passes that along to the end consumer. So the American public is kind of a consumption tax, if you think about it, but it hasn't been affecting the stock market at all. The things that are affecting the stock market right now are mostly due to interest rate movements in the economy. What was the most important lesson of 2025? It was when the tariff announcement happened. You remember in April of last year when President Trump held up that big sign, had all the tariff numbers on it? The stock market fell 4.8% on April 3rd and then 6% on April 4th. Back to back. Levels not seen since COVID. Okay, COVID. The Great Depression. There were days in April of last year that were the worst days Ross and I have seen in our entire careers. And it was due to the tariff announcement. Why? Because the market had no idea what was going to happen. It had no idea. Are we really tariffing this, the EU at 50%? Are we really tariffing China at 200%? It had no idea. But then on April 9th, the administration walked back some of those tariffs and the stock market rose 10%, the 8th best day of all time. Okay? 8th best day of all time. And this all happened in the span of basically 7 days, 6, 7 days. So the most important lesson of last year is this is how the world works. That the best days are right next to the stuff where you just like, you hate the market and you're like, I want out. A few days later is the 8th best day of all time. And I promise you, you do not want to miss a day where the stock market rises 10% in one session. 10 in one session. Again, what moves the US stock market? I have 4 things in my blog, but one of them is earnings, investor sentiment. Tariffs were something that would definitely impact earnings. There were companies that were like, we have no idea what this is going to do to us. And that bothered the market. But once clarity happened, we reached new all-time highs. So Ross, we got 2 slides left and we'll do a little bit more Q&A. Now's a great time to ask questions if you're in. There's been plenty of questions asked so far. So make sure if you got something on your mind, throw it in there and we'll definitely address it. Ross, I want you to talk about the next slide because you and I talk about this all the time. What do our clients need to know about this?
So Mike and I do feel like a lot of our job has become kind of myth busting, pushing back against common media narratives that get pushed a lot. And in today's day and age, right, you're getting blasted with more news information than literally any other cohort has in the history of mankind, right? We have our phones in our pockets, our TVs on, our screens everywhere, and the competition for your eyeballs is as fierce as it's ever been. And the thing that these media companies have learned, and it's not a new lesson, but it's really being taken to its logical extreme, is if it bleeds, it leads. And so the negative headlines are persistent in good times, in bad times. And so when you see headlines like these, they're scary, right? 2022, this was basically ticked the low. It was October of 2022. Forecast for US recession within year hits 100%, right? That didn't happen. Why a global recession is inevitable in 2023? Didn't happen. 2024 will be the biggest crash of the in your lifetimes. Obviously didn't happen. The stock market is getting scary. Here's what you can do. Mike and I have charts of this that you could drag this back to the 2010s, to the 90s, to the 1800s, right? People really respond more to negativity than we do to positivity. And it impacts how we view the world and how we think about stocks. So we are not allowed to, guarantee future performance, but I will guarantee that if you turn on the news, you will see headlines like this year. And more often than not, it makes sense to completely ignore them and touch base with your advisor. This is the number one most common thing that we see is some version of, hey, XYZ said something scary. What should I do about it?
There's a question here, which is a good question, is where should we look for news that we can trust? Please be specific. It's a great question. And I think about this all the time in my life too, because if my career is about synthesizing news and markets and stuff and delivering it to clients to help them manage their financial lives, I need to have good input. Ross and I need to have good input, right? Because if we're digesting bias and putting that into our work, that doesn't help you at all. I can't speak to like where you would get your best geopolitical news, but when it comes to the market, I think Bloomberg does a really good job of synthesizing market news with what's going on in the investing world. I think Bloomberg does a really, really good job at that. And that would be my pitch to you if you're looking for a news org. But in my view of the world as it exists in 2025, the best place to find quote unquote news is to have a list of people you trust and follow their social medias. I think that is probably the best way to go about it because you want to bypass the filter of an organization that could be filtered for left, right, center, whatever. You find a nice, diverse list of people you can follow on X, Twitter, or LinkedIn, or other social media platforms, and you follow them. I have a Twitter account. I synthesize news all the time. Okay, Bull and Baird, at Bull and Baird. I have a Twitter account. People say I put you in my list with this thinker and this thinker and this thinker, and that's my news. That's the best way, I think, where you can avoid the bias of media, where you just find the people you trust. Again, you want to make them a diverse set. You don't want all the same thinkers, and follow what they're talking about. There's a man named Morgan Housel that wrote a book called The Psychology of Money. I think he's an amazing follow. A guy named Connor Sen, who's an economist. I just follow them directly. And I think that's what you should do. Okay, let's just wrap up because there's a lot of questions coming in. So I want to get to those because stuff on clients' minds is great. It really helps us a lot. This is like the wrap-up slide. I'll just say a couple things. I'll let Ross riff on it too. Look at this image on the left. Okay, this image on the left, I think, is a really good description of what a lot of us face in life, especially with your money. Especially with your money. There's reality, there's your imagination, and a circle of problems. And those problems very, very often don't really move over into reality. That is a major, major problem that I see with the average person who's just trying to get through life and all the noise, is that they think that everything's a problem when in reality it's really only a small sliver. Like, I remember a couple of years ago, we're talking about the decline of the dollar, or central bank digital currencies, or the national debt, like a whole host of things that really weren't problems in reality. And then secondly, the second image, and then Ross, I want to let you weigh in on either one of these, is a great image by a man named Carl Richards. He says, security is a feeling, not a number. I want you to think about that when you think about your balance at Baird. When you open up your Baird statement, you say, there's my balance. I want you to know that in general, human beings don't find security from that number, because that number goes up and down. That number's never enough. You may have gone from 1 million to 2, but 2's not enough. Now you want 4, and 4's not enough, but now you want 8. Security with your life and your goals and your purpose and your financial planning is a feeling. It's tough to put it to a number, because again, what if we have a 20% sell-off because of midterms? That security that you think is the number actually isn't. So it's an important thing to dwell on as you start another year as an investor with Baird and partner with us. We want you to experience that feeling of security and know that that number will never do it. Ross, any final thoughts on this?
I like how you ended it. I want to get to some questions. You want to do that?
Yeah.
All right. Put it on the disclosure slide, and let's do some of these, because
we got a bunch here. Just pick one out and kick us off.
Okay, so I want to start. One person said, you said Greenland could affect consumer and earnings. What should we do to brace for that? Let me back up and clarify what I meant. The market sold off yesterday. We had our worst day since October, second worst day since Liberation Day tariff, all the volatility last April, because the threat of higher tariffs is the kind of thing that could impact corporate bottom lines, right? Now, the administration has already kind of walked it back, and I think there's probably, deals to be made. Same as in April, same as all last summer. This administration loves to negotiate. My point only being, the stock market moved yesterday when it didn't after Venezuela, because there were more of those kind of like core things that matter to the market on the line. And whether it bears out or not, the market is going to try to, discount every version of the future and bring it all together in one stock price, or, price for the market. So I don't think we need to do anything to brace for that. I think that there will be deals on this. I think that, we'll probably get to a conclusion that maybe makes some people grumble, but looks a lot like it did when we were coming out of last April, or like we did in the trade wars from the first administration. So I don't think that people should react with their portfolios to the news coming out of the geopolitical sphere right now.
All right, let me just tick off a couple here. Michael, can you repeat the name of the two people you like to follow? So Morgan Housel, Housel, Morgan Housel, wrote the book Psychology of Money. Right? By the way, amazing book, maybe the best investment book ever written. Morgan Housel. Then the other guy's name is Connor Sen. He's a Bloomberg columnist. I mentioned I like Bloomberg because I think it's a good market-related news source. Connor, his last name is Sen. He talks about housing and demographics and I think he's a really good social media follow. He talks about a lot of things that I think impact the market in really unique ways. So those are two that I think are great places to start if you wanted to start to build like a social media following. What are your feelings about investing in Bitcoin and cryptocurrencies way back at the beginning? I've done some content on this. Baird as an entity is still trying to think through this asset class and what it means for you. How do we keep you safe and protect your money and not get, there's a lot of, bad actors in this space. I personally don't invest in Bitcoin, and I don't consider it something that I'm interested in. I don't know about Ross's views on it, but let me say this. There's lots of things you can invest in life. You can invest in wine. You can invest in land, stocks, bonds, cryptocurrency. You can invest in a lot of things in life. You don't need to invest in all of them. You just don't. There are things that you just don't even need to bother with. And I think Bitcoin's one of those. Could it go up a lot? Sure. But there's also a lot of stocks that can go up a lot. There's lots of wine that can go up a lot. There's lots of art that can go up a lot. Just because something goes up doesn't mean you should invest in it, right? Because it may not fit your financial plan. It may not fit your personality. I do think if you're kind of just curious about Bitcoin and cryptocurrencies, I would explore it with your financial advisor. I would talk to them and say, what do you think? Does it make any sense for me? But personally, I put that stuff in the too hard bucket. Let me tell you why. I have no idea what makes Bitcoin go up and down. I have no idea. I don't think anybody does. And I don't like to invest in things that I have no idea why they do what they do. I'm not interested in that. Like, I don't know what makes Ethereum or Solana go up and down. So I just think that there's things in the wealth management space that you should probably ignore. Ross, why don't you pick us another one?
Yeah, this is in the news right now, so I think it's a good question. Basically about how we should think about the $1 trillion of U.S. debt that are owned by foreign countries, and really we get a lot of questions about the U.S. debt in general. We have a lot of content out there, so I'm not going to rehash everything we've ever said about the debt. I would say that there's some stories that countries that want to push back against the U.S. would sell treasuries as a way to kind of punish the U.S. if they own that. That would also deeply damage them because they own the treasuries. They own huge positions. China has been selling treasuries for 5-10 years now, slowly, and we haven't really noticed in the market. Foreign ownership of U.S. treasuries and debt is at all-time highs right now. People still want our debt. It is still considered a tremendous safe haven asset. That is not something that I worry about really at all. I guess it could be considered a nuclear option if a country really wanted to go to kind of economic war with us, so to speak. But it would also damage the owners of those assets in a material way. So I don't think we're there yet, and I don't think it's something we need to overthink or spend too much time on. Most ownership by like a pension fund or some sovereign wealth fund is a drop in the bucket compared to how deep and wide U.S. capital markets are.
Okay, let's do precious metals. I knew somebody was going to ask this question. Right now, gold and silver are like the number one question that Ross and I get asked. And I'm just going to throw in my take that Ross definitely weigh in on this. Here's what I want to say about the price of gold or silver. Gold right now kind of represents this asset class where people are saying, I don't trust the dollar anymore. I don't know what's going on with money printing. I'm going to buy gold because, the world seems awash in debt. That's really the theme behind gold. Gold it's not a great inflation hedge, by the way, because we had an inflation episode in 2022 and it really didn't hedge it all that well. Gold has just become this asset class where people are like, I don't trust monetary systems, so I'm going to invest in gold. I don't think a good thesis for investing in gold is, I think the world's going to implode and I'm going to hoard this gold and spend it when the world implodes, because number one, you're not going to want to live in that world. That world will be very bad. And number two, you're not going to be able to spend it, right? The notion of holding gold to hedge some apocalypse, I don't think makes any sense, because it just, you don't want to live in that world, and you're not going to go to Walmart and spend gold. It's not going to happen. So if you do want to invest in gold, I think, and you want to, again, you don't have to. If you do want to invest in gold, just know what's moving it up and down. What's moving it up and down is people's views of monetary systems. Silver, on the other hand, silver has become this hot craze, essentially. Silver has gone vertical in price. Silver doesn't represent a view of like monetary systems at all. Silver is just this year's version of GameStop. Does everybody remember GameStop? It was this stock that went vertical a couple years ago. AMC and GameStop, they were called meme stocks. They just went vertical. Silver's just that right now. So I don't know. I wouldn't want to invest in something that's gone straight up, knowing that it can go straight down rapidly. And I traded commodities for a living for about 4 years earlier in my career. And if you were to invest in a commodity, know this, it can go down and you can't get out. There are limits in commodity prices where they move limit and you can't transact. They're just, again, let's go back to the notion that you don't have to be in everything. Somebody said, well, gold went up 60% last year. There are 30 plus stocks in the S&P 500 that went up more than that. There are lots of things that go up. You don't need to be in all of them. You need to be in the things that make sense for you. Ross, any precious metals takes?
Yeah, too quickly, but you covered it really well. I mean, I think one, gold doesn't spit out any cash flows. It doesn't have any earnings. It's entirely dependent on the narrative, right? And that can be really powerful, and gold can go up 60+% in a year. But it shouldn't, to me, be a return driver for your portfolio. If you want to own it, in some smallish percentage as like a hedge or an uncorrelated asset, which is a wonky term for something that in theory moves differently from your stocks and your bonds. Yeah, I'm on board with that. I'm not typically a huge fan of any asset that doesn't like do something for you. But I get it. And I think that's totally fine. And you know what? Good news is I forgot the second point I was going to make, so we can move on to the next question. I want to quickly grab one. They're coming in fast. Thoughts on quantum stocks? We wrote a piece out of our market strategy team in conjunction with some of our equity analysts. It's a great kind of 2-3 page overview of the quantum landscape. Ask your advisor for that. We'll go. We have that piece. Reach out. We'll make sure that you get it to dive a little deeper on it.
Let me just rip this one. I'm 68 years old. I'm investing conservatively right now. I don't want to miss out on the potential of the market exploding. Should I invest in more risky funds for the next 2 years? I'm just going to say no. I think that you should talk to your advisor about this. Is a great question to talk to your advisor. And let me say why I say no. 2 years is an extremely short time frame for the U.S. stock market. Super short. 2 years is preposterously short to say I want to be in a riskier investment. Why? Because 2 years, anything can happen in 2 years. Literally anything. The stock market could be down 50% in 2 years easily. The stock market could be down 50% in 1 year. It's happened 3 times in history. Remember, when it comes to investing in the stock market, time frames is your number one question. Actually, your number one question is what's the reason for this money? Your number two question is how long do I want to invest it for? If you're saying I want to invest in the U.S. stock market, your thought should be 10 years. Like that's where my mind goes. 10 years, 12 years, 14 years. That's where your thought should go. Because that's how long it takes for these companies to grow their products and grow their profits and those things. 2 years is super, super short. That's way too short to say I want to aggressively add to stocks. What is this money for? How long do I want to invest it for? Are the number 1 and 2 questions in your mind. And remember, the older you get, again, you want to be more reliant upon your nest egg and not risk it. So 2 years is a really short time frame. That's the only reason I said no, because it's just really, really short. Let's see. Where was another one? There's just more silver questions. Let me just kind of go a little bit further into silver. In my view, silver has become akin to GameStop. I don't think that means the parallels are 100%. But when I say akin to it, I mean it's just become this momentum-driven asset that has no fundamentals and realities. You could say silver has industrial uses, but why is it going vertical? You know what I mean? Like, what would make silver go vertical if it had industrial uses? Silver's been around forever. Silver's been around for thousands of years. It's gone vertical recently because momentum money and hedge funds are all piling into it at the same time. Should you sell it now? I don't know. We don't have commodity analysis like on our plates. But just know what you're in. Again, if you own silver, why am I in it? What's my thesis? What makes it go up? What makes it go down? Those are great questions to ask yourself. And again, they're hard to answer because precious metals generally don't go vertical. The prices generally don't go vertical in normal markets. If you look at the history of silver, you could go all the way back to, I don't know, you could take it back 50 years and you're very rarely going to see a move like this. So I'm just saying be cautious with what you own. I'm not necessarily saying sell it. I don't know where it's going to go. Neither does Ross. We don't have no idea where silver is going to go. But just know why you own something. Why am I in it? And what is my plan for that? Those are great advisor questions.
Yeah, I would say let me just add to that while you look for the next question. I can't speak to your situation specifically, but if you own silver and you're up huge, it could keep going up. But there's a like a concept of regret minimization. Like would you be happy with the gains that you have now? what would happen if it went down 50% in the next couple of weeks, because it could. This is a question that has popped up with Bitcoin, in recent years too, because it like, meme stocks or SPACs tends to go vertical at times and really just rip. And the question is like, it comes back to what Mike said, why do you own it? But would you regret if you didn't,
Yeah.
grab the gains when you could? So, it's a great advisor question,
Yeah.
but,
Do you think tech stocks are rise significantly this year? I mean, tech stocks are on a historic run.
yeah.
The NASDAQ 100, these tech stocks are on historic runs, and they have been for a while. Do I think significantly? I mean, I don't know what we would define as significantly, but I do think that we'll have another good year in the stock market. And again, based on the history that I just mentioned earlier in the deck, we're doing a national investment in tech right now. We're putting close to 1.5% of our real GDP into AI, essentially. And I think that's going to go on for a little bit longer. Again, 5 years was the average national investment. We're only a little over 3 for AI. But do I think they're going to? Again, that's on any 1 year basis, that kind of prediction is really, really hard to make, because what if something really bad happens in the world and it had nothing to do with the tech stocks, but all of a sudden people don't want to be in the stock market anymore, right? But I do think that the trends still are intact for what's been happening in those names. Then somebody else asked a small cap question. Should I overweight small caps now, or were they disappointed again? Yeah, small caps have disappointed for a long time. They really, really have. That's the understatement of the century, given how much the large caps have done. I would say the small cap index benefits from a rotation away from tech, right? Small caps do well when those Mag 7 aren't doing well, and energy and industrials are doing well. And we've started the year pretty good in that space. If I pull up a chart of the Russell 2000, which is the small cap index, it's making new highs. So I think the market is starting to reward small caps. But a balanced approach is always the best. Overweighting sectors based on 1 year, that's just really gambling. That's just really hard to do. I think you should have a diversification plan with your advisor and stick to that. I wouldn't be rotating in between them, trying to play 1 year trends, because again, that even hedge funds really struggle to do that. And they have 50 PhDs looking at that kind of stuff.
We have like in our toolbox, like the classic quilt chart, right? Like how all that different asset classes do year in and year out. And it basically looks like a color splotch, like all the, some years it's commodities, some years it's gold, some years it's growth stocks, some years it's small caps. I would say, to Mike's point about rotation, and this was looking at this yesterday, we had this big sell off of the stock market, and small caps meaningfully outperformed. And you don't usually see small caps outperform on big down days, because they tend to be a little more volatile. So to me, if a lot of the anxiety is coming from developments abroad, but we have this domestic economy that is really strong, you've got AI spending, you've got a solid consumer, you've got all this stimulus coming, I do think it could stand to reason that small caps could catch a bid here. Now, that you could have probably made a small cap argument, or an international argument is the same way. Like, how many people have made arguments for international over the last 15 years only for it to be a head fake and be left disappointed? I would also just add, this is the way that you invest in small caps matters. So there's two main indexes, and this is getting wonky, but one includes companies that don't have profits. One only includes companies that have profits. And a lot of small caps are profitless. They're small cap biotech companies that are trying to shoot the moon on one drug. So think about how you want to invest in small caps. If you want that to be a sleeve of a diversified portfolio, then it's a perfect time to talk to your advisor about it. But I'm with Mike. I mean, in and out, year to year, you'll get, even if you hit it a couple of times, you'll get left behind eventually.
Okay, we're going to wrap this up. I'm going to give you a place to get more of Ross and I, and then I'm going to pass it back to my friend Colin to wrap us out of here. So Ross and I produce content for Baird and its customers, you and our advisors, all the time. And we are primarily focused, Ross and I, on busting myths, answering questions about politics, national debt, all this stuff that we're doing here. That's our specialty. BairdWealth.com, one word. If you haven't been there, please go there right now. BairdWealth.com, one word. It's a repository for all of what we do. If you land on that page, there's a little link along the top that says our expertise, market insights. That's us. And our partners at Strategas, who are also amazing. It's all right there for you. All That Matters videos, blogs, what moves the stock market. Ross does a 5 for Fridays, which is awesome. Engage with us there. We're on socials. We're on LinkedIn. We're on YouTube. We're all over the place specifically to help you through difficult times, okay? In plain language, English, not overly complicated terms, okay? We're here to help guide you through those difficult moments. So if there's anything we didn't answer, send it to your advisor right now. They will chat us and we'll answer it right away. If you didn't want to put something in the chat, send it to your advisor. They will chat us. We will answer it right away. Ross and I love doing this because we get immense satisfaction about helping you through difficult moments. I know your advisors do too. All of Baird does. And the simple fact that we get such great engagement from our customers on markets is a testament to our product and how well we put together simple, easy to understand ways to navigate the world. Images that matter, thoughts that matter. All That Matters. That's the name of our brand, Ross and I. It's really, really, if you've been watching All That Matters the last few years, I think you'd have a real good grasp on what's happening in the world and your investments. I think you would. All That Matters is not very long. Our goal this year is to do 7-minute episodes. You can last 7 minutes, trust me. Ross, any final words?
No, you brought us home well. Let's give people the rest of their day back. Colin, you want to take us
All right,
home?
Colin, wrap us up.
All right. Thank you again, Mike and Ross, for sharing your insights, and thank you to everyone who joined us today. We hope you found the discussion valuable and a worthwhile use of your time. If we weren't able to address your question, or if you'd like additional information, please reach out to your Baird contact, like Mike said, who can connect you with the appropriate resources. For those who would like to revisit today's presentation or share it with others, the session was recorded and will be available in approximately 1 week. You can access the recording through your Baird financial advisor or by visiting bairdwealth.com. If you're not currently working with a Baird advisor or would like to explore that opportunity, you can find an advisor near you by clicking the Find a Financial Advisor button on our website. Thank you again for joining us, and we hope you have a wonderful rest of your afternoon. Thanks, everyone.